Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with myself, Will McBride, and the main man from South Jersey, where it's beautiful and sunny this morning. Is it sunny out there, D?
Good morning. Yeah, it is sunny actually.
Dimitri Pargamon.
Very nice day.
Because it's wet and
Right.
overcast here in Bucks County. I don't know.
Oh, really? No,
It's amazing.
Nice
The shore draws the sunshine. It really
Definitely.
does.
At least
All right, you
this
want to
week.
start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Perfect.
And with that, let me share my screen here. And if you guys are joining us for the first time and you have any questions, you can put those questions in the live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on a show and ask your question directly, we also put out a link to Zoom. Click on that link. It takes you over to Zoom. Once you get over to Zoom, there's a button, raise your hand. Click on that button. You'll be able to ask everybody will be able to hear you. You could ask your question live. You don't have to turn on your video camera, but those are two ways to ask questions. While we wait for any questions to queue up, I'll start out taking a look at what's going on in the pre-markets. We'll take a look at stocks trading in pre-market hours. I'll move on also to talk a little bit more about financial models and pricing of stocks and options, and just kind of open up that discussion, see if we get any questions to come in. So let's start out right now with the pre-market report. And if you have any questions popping in, let me know. I'll stop and take those questions.
Well, we do have a question about the Tesla split. I don't know if that's something you want to look at after the pre-market report.
Okay. Is it a specific question on the split?
He was wondering if it's Thursday, I think they asked, and maybe how it affects the options.
Okay. All right. So let's start with the pre-market report. I don't know exactly. I'd have to go look up when the split is.
Let's maybe we'll carry that through to tomorrow. The Tesla split.
All right. Sounds good. So let's start with the pre-market report. Maybe I'll just guide you where you could start looking for information on splits, and then we'll move on. All right. So pre-market report, these are stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Down here, I see 57 stocks made our percentage gainers list, 195 on a percentage decliners. So from this perspective, it looks like we're setting up for more bearish bias at the open. I'm going to filter out this list to just S&P 500 stocks. So this way we will take out small cap stocks, ETFs, preferreds, leverage products, closed-end funds, all those stuff. We're going to take those out of our list just to focus on S&P 500 stocks to see what's going on there. So to do that, I'm going to use this filter here in ETF. I'm going to drop it down, and I'm going to select, by selecting one of these ETFs, the list below will get filtered by the holdings in that ETF. So the first one, SPY, that's S&P 500 ETF. Select that. Now this list got filtered by SPY holdings, which are the S&P 500 constituents. And here we see one stock made our percentage gainers list, 41 on the decliners. So again, that is looking like we're setting up for more bearish bias at the open. Let me take a look. If there are no questions on the pre-market, what we'll do is, well, so about Tesla. And when I'm gonna come back to Deere. I think we also had a question on Deere, so I'm gonna come back to that. But if you guys are interested in corporate actions and how that corporate action will impact the options. You could go to the OCC, the Options Clearing Corporation, and the OCC clears all the options. They issue memos, informational memos about corporate actions and how that will impact existing options. So over here, information memo. I'm gonna click on that. And once you get over to there, we're going to take a look at if they issued us any guidance, let's say on Tesla. So let's do that search keyword. Let's see if we get Tesla. So here you got 3-for-1 stock split, right? Open that up. Let me see if I could open up that memo. And this is really where you want to, go to really verify what the, let me see, I think it's still downloading. Let me see if it's ready. So this is really where you want to go and, confirm, the corporate action and the impact it will have on existing options. So they're telling you here the effective date, and then they're giving you here how the options will adjust for the split. So keep in mind, they have to adjust the options somehow for the split to compensate for that, right? So it's not, so basically the value of the option prior to the split will hold the same value post split. And here they're shown what it would look like if the old strike, right, was 10, the new strike will be 333. If the old strike was 15, the new strike will be 5. So you could see that they're adjusting the strike prices of the old options to reflect the split of those options, post split. So August 25th, that's when the split, that's the effective date. And this is how the options will be adjusted. Okay, so now you could see what your new strikes will be. It looks like the date. So it looks like, I'm not sure what 2 Tesla remains 2 Tesla. I'm not sure what that 2 Tesla is, but it'll be the same. It looks to me like, Tesla's, there's no simple change. That's what that's indicating. Tesla's going to remain Tesla. Hopefully this helps, but this is really where you want to go to see what the corporate action will be and how that will affect the adjustment in the option contracts. So hopefully that answers the question. You're on mute.
Sorry about that. I said that was great. Very helpful.
Okay. Let me go to, I think there was a question. It was on Deere. And I don't think it was a specific question we had. It was just that Deere had earnings and to take a look at Deere. If there's a specific question, let me know if the person's still on. But, without having a very specific focused question, not sure how to answer it, but what I'll do is just kind of review a financial or one of our calculators, pricing calculators, and open up the discussion that way. And let me take a look over here at our fair value calculators. And we have three different calculators right now, and as I build them out, I'm trying to make them very, very simplified in the beginning for the purposes of just explanation. Because as you build them out and get more complicated, it takes more explanation. In the beginning, we just look at historical multiples. So based on historical multiples of Deere, we can look at different multiples like PE ratios, price to sales ratios, price to book, price to operating income, and also how those P ratios and multiples trade at a discount or premium to the overall market. And by doing that, if we apply the historical multiples to the most current, earnings, to the most current sales, we could estimate what would the price be using the historical averages. And then we could take the average of those and get a number, right? So this way we could kind of get a sense of where the market is today versus where the market was priced relative to historical multiples. And you have a couple features here that allow you to change the date range, 5 years, 3 years, or uncheck some of these multiples. So if you just were curious, price to sales, you could just uncheck these others, and now you're just limited to price to sales multiple. Okay. And that, looking at historical multiples would really just use basically historical numbers. But we know that the price of a stock is reflecting a future expectation. So when we look at a price of a stock today, it does take into account whatever the earnings were, whatever the debt, assets, all that. Yes, that's priced in. But really what the price is reflecting is a future expectation of the performance of the company, right? So it doesn't matter if it earned a lot today or a lot this year. The future expectation is that the company is going to do poorly. That's going to be reflected in the stock valuation. And maybe if the company did not make a lot of earnings in the last year, but the expectations of the future are optimistic, that will be reflected in the stock price as well. And the hardest part is to take that price, right? Take that price and work backwards to try to estimate what are the future expectations. What are the future expectations for this company? And do I believe it's too optimistic? Is it too pessimistic? Is it right in line? And that's where the work is cut out for you, because there is no right answer, because it's all based on expectations of something happening in the future, and that's unknown. That's unknown to everybody. So I don't know, in a year, 2 years, 3 years, 4 years, or 5 years, if Deere is going to make a ton of money, or they're going to lose a ton of money, or what the economy is going to do. All this is all a guess. It's a prediction. It's an estimate. And for you, the hard part is first to try to figure out what are people, what are they pricing in, and what do I think is going to happen, and then try to make a trading decision on that. Right? So does that make sense? So we're looking at what do we think, this price is signaling about future growth in revenues, future earnings. Those are the two really important ones, right? How much money are they going to make in the future? So on this comparative model, what we do is, and there are different ways to estimate. I don't want, so you guys know there's no one right answer. A common model people, I think, will turn to that probably, can apply to most stocks, not every stock, but to most stocks, is the discount cash flow model, right? So, or they'll refer to as the discount free, unlevered free cash flow model. So a lot of investment bankers will use that. You could go online and look it up. The problem is that a lot of companies have their own nuances, and you have to know how to read their income statements, balance sheets, and so forth to kind of construct it. So I'm not going to do that here, but that is a common way of trying to estimate the price of a stock by building in an expectation. And in this model that or calculator that I built is simply taking the following, saying, let me first figure out, the S&P 500, right? And these are the estimates in the S&P 500 because they're smoother, they're not as volatile. And what do I think, the expectations are being built in there? And then comparing it to the individual stock to say, well, what would the price of this stock, be worth? Where would I price it if it just matched the S&P 500? So that would be my benchmark. In other words, if I think that across the board, right, if I was buying a rental property and I thought nationwide, right, across the board, that the cap rate, the rent to what I should be paying for the price of the house was 10%, right? So if I paid $100,000 for this house, I should earn $10,000. If I paid $1 million, I should earn $100,000 in rent. And if I applied that cap rate, to this individual house, what do I think it would be worth, right? Because if it's not, then if it's not making at least that amount, then you have to justify it because then you'd be better off just buying S&P 500. The other reason I use the S&P 500 is for the following reason. I don't know, right? I don't know what the future earnings will be in SPY or DE, but I do know that I can hedge one against the other. In other words, if I think that Deere will outperform the S&P 500 in an up market or down market, well, I could short SPY and use the money from that to buy Deere. So then I'm hedged off my market risk. So maybe potentially they could both go down, they could both go up. But if my estimate is that Deere should outperform its earnings in the SPY, then I can hedge one against the other. Okay, so that's why I'm using this benchmark against this to price the stock. Does that make sense? Well, hopefully the way I'm explaining it makes sense. So let's take a look here.
Yeah, everyone is getting it and super thankful for this description.
Awesome. All right, so let's just take a look at the calculators using SPY, S&P 500, and we're going to say here's Deere, here's SPY, here are the initial annual revenues, right? So we're going to use the most recent trailing 12 months, Deere and SPY, and the question is the following. What do we think the revenue growth of Deere will be in the next 5 years? And what do we think the revenue growth will be in the S&P 500? And we also want to know how much profit margin is Deere going to generate, and how much profit margin is the S&P 500 going to generate? And this will give us a projection of their earnings, right? How much earnings are they going to make in the next 5 years? Next question will be, all right, now that I have the earnings, let's for simplicity, let's say that's the rent we're going to collect, right? How much am I yielding? In other words, what is the enterprise value? If I bought all of Deere's stock today, just bought all the stock out and paid off all the debt, that means I'm entitled to all those earnings. And if I did the same thing for the S&P 500 and bought all the stocks in the S&P 500, I paid off all the debt, that means I'm entitled to all those earnings as well. Well, where would I yield more, right? Which one is the better investment? So the better investment will be the one that yields more on your invested dollar. Okay, so that's the objective of this calculator. And and then it comes up with a fair value. Like where would this stock, the implied value be, just to equal the same returns. All right. So let's or otherwise there'd be, we could say there'll be an opportunity to buy one, sell the other. So, but how do we come up with this, right? So how do we come up with the projection? Because we have no idea, and nobody knows for sure, right? We have no idea if Deere will grow or not grow, if the S&P 500 will grow or not grow. We have no idea, so we have to come up with a guess, right? And for one, we could take a look at the historicals and say, all right, we could use the historical growth rate. So we see Deere in the last 1 year, they grew almost 15%. But in the last 3 years, year over year, they grew at 5.4%. In the last in the last 5 years, they grew year over year 11%. So we do have a bunch of different numbers here, right? And we don't know what to use. We kind of have to make a judgment there, or we plug in our own, right? Or we just plug in a number ourselves. And here's the S&P 500. So we see in the last 5 years, 7.9%. That's the revenue growth. So sales increased 7.9% year over year. 3 years, it's been 7.8%. Then the last year, we saw a bigger increase, 16%. And this is a hard one. And one thing that's common for people to do is come up with an optimistic viewpoint, a average viewpoint, and a pessimistic to get different prices. So for example, maybe a pessimistic will be 5.4%, right? So let's say 5.4% Deere will grow at that rate. And let's say S&P 500, I'll give it a more optimistic 10%. But besides the revenue growth, out of that revenue growth, we got to figure out how much are they going to earn, right? So yes, they're going to sell out of $1 in sales. How much do they keep as profit? So I'm using the operating margins here. And if here we say 19%, which is the most current, that's implying that for every $1 in sales they have, they're going to keep 19 cents as profit. S&P 500, 15.1%. So I'm going to give it a pessimistic view, right? And then we'll do an optimistic view. And I'll say, Deere, a pessimistic view is, let's say their operating margins fall here, 11.6. So that in the 5-year average. And I'm going to leave S&P 500 at 15.1. So here I'm giving, remember, based on these numbers, I'm taking a pessimistic view out of the numbers in front of me. And I'm going to recalculate that. So after I recalculate it, you can see that here, that would imply that Deere would be valued at 185.08. Okay. So I'm not going to go into all the, I don't have enough time to go through the whole calculation, but that's what it's implying. Now let me give it a different viewpoint. And when we set these, we could also look at the guidance. And I took the last press release from Deere, and I wanted to see what is the company guiding us going forward. So this is the earnings press release. And I kind of stopped at their guidance here. So here they have an outlook for 2022. And they're talking about net sales. So net sales, they're looking at, they divided, it looks to me like there are different segments that the company operates in. So you could see here production and precision agriculture. They are guiding that for 2022, that net sales is going to be up 25 to 30%. Then they give us some, I got to read what this means, but I guess that there's also a currency effect on it. So do give some adjustment, but let's just use these for now. Okay, so 25 to 30%. Small agriculture and turf, they're saying up 10 to 15%. Construction and forestry about 10%. And I don't know what this means. So here, I think they are guiding us pretty much higher. And I'm just going to use, let's use the 10%, right? So let's say it would, and look, I'm eyeballing this. I'm doing it very quickly. It's a simple calculator just to plug numbers in. So let's go back to our deer. And let's say that the deer will grow at 11%. And the 5-year average is 11%. Looks like that's where they're guiding us here. Let's say S&P 500 continues to grow at the same rate it did in the last 5 years. So the last 5 years will look like the next 5 years. And for the operating margins, I'm going to do this. Let's do a more optimistic view. That currently they're at a 19% operating margin. So let's say they continue that. They're able to keep 19 cents out of every dollar in sales versus S&P 500 15.1. I'm going to recalculate that. Based on that, you could see now the market price looks undervalued, because at that, we would say that the price should be around 457 versus the market price 369. So what I'm doing here is taking in an expectation, and based on those expectations, I'm trying to come up with a reasonable valuation. But I don't actually know what Deere will earn or what the market will do. And I'm building myself pessimistic view outlook, an optimistic outlook, maybe a medium on the average, to see how far away the current market is from those implied values. Hopefully that makes sense to people. Well, let me know. Yeah, boy, you're
Sorry, I had my mic off, so our mics didn't cause you to go fuzzy. But that was great. Everyone was super thankful. We did have some questions about reverse splits versus regular splits. One of the chameleons got caught, I guess, with a reverse split, and Fidelity maybe not let him roll out of that. I haven't heard of that before. Once a reverse split. I'll copy the questions down. Maybe we can look at it next week. I don't know if you have any insight into reverse splits and how those could affect the options. But anyways, there were some discussions around the splits, some discussions around Deere. Great job, Dee. Thanks so much.
All right. Awesome. Well, thanks everyone for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, chameleons. Have a